Would you like to own a slice of one of the best real estate companies in the world? Want to buy Dividend Aristocrat while it's trading for 2014 prices? Like the idea of collecting market-smashing passive dividend income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing people with a basic need in the form of housing. We can't live without shelter. It's not really a negotiable point. And this company owns some of the best apartment properties in some of the most desirable locations. This stock has vastly outperformed the broader market since its 1994 IPO, and there's little reason to believe it won't continue to do so. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of ESSEX Property Trust Inc., which appear to be trading at a significant discount today. ESSEX Property Trust Inc., stock ticker ESS, is a real estate investment trust that owns and operates a portfolio of U.S. West Coast multifamily properties. Founded in 1971, the company is now a $13.5 billion by market cap REIT giant. The company focuses on three different supply-constrained markets: the San Francisco Bay Area, 42% of net operating income for fiscal year 2019, Southern California, 41%, and the Seattle metropolitan area, 17%. Their portfolio consists of approximately 60,000 apartment homes across almost 250 different apartment communities. Whereas a lot of REITs concentrate on more discretionary areas of real estate, ESSEX concentrates on the non-discretionary need that is shelter. This has been one of the most successful REITs since going public in 1994. The stock's total return absolutely trounced the S&P 500 between its IPO and the end of 2019, up almost 5,000% compared to the S&P 500's total return of less than 1,100% over that time frame. But 2020 has been a rough year for this stock, as well as most REITs in general. There could be a paradigm shift upon us in terms of housing demand on the West Coast, with taxation, high cost of living, political issues, homelessness, and the accelerating work from home theme all conspiring to work against ESSEX. Or maybe not. Other than the work from home acceleration, none of this is new, yet ESSEX has thrived. Moreover, demand reduction is only one element of the supply and demand equation. Factors like land availability and zoning restrictions constrain supply. I'd also argue that this demand shock is temporary. The West Coast of the United States remains an extremely desirable geographical location. Its natural features have blessed it. In addition, California has a massive economy. It would be in the top 5 of the world's largest economies by GDP if it were an independent country. Also, not all of those industries in California are going to allow for 100% mobile jobs. Even a requirement to show up to the office for, say, a tech-oriented job only twice per week means you'll still need to be based near your employer. There's also the likely downward adjustment to pay if an employee works from home and moves to a state with a lower cost of living, which could cause some to rethink leaving California. California has competitive advantages, much in the same way a business can have competitive advantages. Despite California's political blundering, it's a sought-after place to live. While pricing pressure might be a very real challenge over the near term, ESSEX is a well-managed business that owns some of the best properties in some of the most desirable locations. Simply put, there are advantageous baselines in play here for both supply and demand, and that bodes well for the company's ability to grow their profit and dividend over the long run. ESSEX has already increased its dividend for 26 consecutive years, making it a rare Dividend Aristocrat REIT. The 10-year dividend growth rate is 6.5%. I think it's worth pointing out how consistent this dividend growth is. The most recent dividend increase was almost exactly 6.5%. That solid dividend growth comes on top of the stock's market-beating yield of 4%. This yield, by the way, is more than 130 basis points higher than the stock's 5-year average yield. And with a payout ratio of only 59.7% of trailing 12 months core funds from operations per share, this is one of the more conservative payouts in the REIT space. Looking at business growth, ESSEX increased its revenue from $416 million to $1.460 billion between fiscal year 2010 and fiscal year 2019. That's a compound annual growth rate of 14.97%. This is obviously highly impressive. However, a REIT often funds growth through the issuance of equity and debt. That's because a REIT is legally obligated to return at least 90% of its taxable income back to shareholders in the form of dividends. Indeed, ESSEX outstanding share count more than doubled over the last 10 years. It's never more important to look at growth on a per share basis than when you're dealing with a REIT. Furthermore, REIT profit is best viewed through the prism of funds from operations. Funds from operations is a measure of cash generated by a REIT, which adds depreciation and amortization expenses back to earnings. The company grew its FFO a share from $5.35 to $13.73 over this 10-year period, which is a compound annual growth rate of 11.04%. Still excellent, although profit growth on a per share basis did trail absolute revenue growth. Looking forward, CFRA believes that ESSEX will compound its funds from operations per share at an annual rate of 2% over the next 3 years. CFRA's call for lower growth chiefly revolves around the pandemic's impacts to multifamily housing, particularly on the West Coast. The pandemic will impact ESSEX. I think it'd be silly to think otherwise. However, this impact doesn't exist in a vacuum. You have to compare the magnitude and time frame of the impact against the valuation of the stock. Regarding the magnitude, we can see that financial occupancies fell from 96.6% in the second quarter of 2019 to 94.9% in the second quarter of 2020. This went from outstanding to slightly less outstanding. Core funds from operations per share dropped just over 5% year over year for the second quarter of 2020. Compared to other areas of real estate, like say retail and office, this is a very minor drop in cash flow. As for the time frame, I don't see a permanent shift here. The locations in which ESSEX has concentrated itself benefit from natural and man-made competitive advantages. And then there's the valuation. The stock is now trading for 2014 prices, even though the company was doing less than $1 billion in revenue back then. This valuation compression is fortuitous in some ways, as ESSEX actually bought back just over $20 million in stock during the second quarter. CFRA's forecast is implying a substantial reduction in growth. I think much of the caution is warranted, but I also see much of that caution already more than priced in. With the modest payout ratio, relative minor drop in cash flow, the prime need of their product, and consistency of the business, I think mid-single-digit dividend growth is a reasonable long-term expectation from here. Moving over to the balance sheet, ESSEX maintains a very good financial position. There are $12.7 billion in total assets against $6.5 billion in total liabilities. Credit ratings are as follows: BBB+ from Fitch, Baa1 from Moody's, and BBB+ from Standard & Poor's. This has been an amazing investment over the last 25 years, and while there are undoubtedly near-term challenges facing ESSEX, I see no reason to believe that the next 25 years will be all that different. ESSEX has the prime need of housing, quality properties in sought-after locations, a concentration in supply-constrained markets, and excellent fundamentals, all working to their advantage. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Real estate is highly cyclical. This cyclicality is being supercharged right now by the pandemic. A REIT's capital structure means they must consistently rely on external funding for growth. ESSEX's West Coast concentration can work against them if this area truly does suffer a more permanent drop in demand. There's also a scarcity of durable competitive advantages in real estate. Even with these risks, I believe that ESSEX makes a lot of sense as a long-term investment. That's particularly true right now with the valuation about as appealing as I've ever seen it. With the stock trading at 2014 prices after a 61% drop from its 52-week high, the stock looks attractively valued. The stock is trading hands for a price to funds from operations ratio of 14.9. Using a price to funds from operations ratio as a proxy for a PE ratio, this valuation is well below where the broader market is at. Then there's cash flow, which mimics funds from operations. The stock's price to cash flow ratio of 14.9 is way off of its own 3-year average price to cash flow ratio of 22.0, and the yield, as noted earlier, is materially higher than its recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. This dividend growth rate lines right up with ESSEX's own long-term proven dividend growth, with the most recent dividend increase coming in at almost exactly 6.5%, and with the payout ratio remaining modest, ESSEX should be able to continue on with the status quo. Notably, funds from operations per share growth has been higher than dividend growth over the last decade. This has created a margin of safety as it pertains to the payout ratio. With the possibility of a short-term expansion of the payout ratio coupled with a temporary reduction in dividend growth, the dividend should remain sustainable and in a position to grow at a faster rate when things normalize. The dividend discount model analysis gives me a fair value of $252.86. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates ESSEX as a 4-star stock with a fair value estimate of $273. CFRA rates ESSEX as a 3-star hold with a 12-month target price of $235. I came out right in the middle this time. Averaging the three numbers out gives us a final valuation of $253.62, which would indicate the stock is possibly 23% undervalued. Here's the bottom line, guys. ESSEX Property Trust Inc. is a high-quality business by any measure. It has some of the best properties and some of the best locations. Near-term challenges have spooked investors, presenting a rare moment of undervaluation. With a market-smashing 4% yield, moderate payout ratio, more than 25 consecutive years of dividend raises, strong dividend growth, and the potential that shares are 23% undervalued, this Dividend Aristocrat is a very compelling investment opportunity for dividend growth investors right now. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.